The dollar's fate is being shaped far more by inflation data than by political meetings, even those as anticipated as the Trump-Putin summit in Alaska. While today's encounter between these two powerful leaders could potentially steer the trajectory of the Ukraine conflict, it's unlikely to create as significant a ripple in the dollar markets as recent economic figures have done. Following a surprising jump in the Producer Price Index (PPI) yesterday, expectations around Federal Reserve policy have shifted toward a more hawkish stance. This has led to a more balanced set of risks for the dollar, making the currency's outlook less clear-cut than before. Let's break it down. The Trump-Putin summit, scheduled for 8:30 p.m. BST or 9:30 p.m. CET, might influence the late U.S. trading session, but the more sizable market reactions could well be delayed until Monday. President Trump himself described the meeting as exploratory, a feel-out, with follow-up discussions likely involving European allies and Ukraine. This suggests that while there might be tentative ceasefire ideas floated tonight, traders and investors may approach such developments with healthy skepticism. Adding to the uncertainty, Trump has estimated a 25% chance that no agreement will be reached today. Interestingly, if talks stall, that scenario could actually be the most supportive for the dollar. Conversely, if progress is made toward easing geopolitical risks, the dollar might come under downward pressure. It's worth noting that oil prices continue to serve as a pivotal transmission mechanism for how geopolitical shifts impact foreign exchange markets. Predicting how this summit will pan out remains a challenging endeavor. However, current evidence suggests the dollar remains overwhelmingly influenced by U.S. economic data rather than geopolitical news. The unexpectedly strong PPI data released yesterday, showing a 0.9% increase month-on-month on both headline and core figures, caught markets off guard. Because the PPI often leads changes in the Consumer Price Index, CPI, and many of its components feed directly into the Federal Reserve's favored inflation gauge, the Core Personal Consumption Expenditures, PCE Price Index, this spike could have broader implications for monetary policy. Markets have been clinging to an anticipated rate cut from the Fed in September, perhaps assuming it will compensate for the pause in July, especially since recent job market data has dramatically altered earlier expectations. Nonetheless, adjustments in market pricing have already begun. The December futures contract recalibrated from a 64 basis point cut to 57 basis points, and the 2-year swap rate climbed by 5 basis points. This hawkish revision could persist, counterbalancing any easing effects that might arise from a peace agreement in Ukraine. On the economic front, today's focus includes July's retail sales figures, which are expected to maintain a steady 0.6% growth pace seen in June. Additionally, the Empire State Manufacturing Index and the University of Michigan surveys on economic and inflation expectations will provide further clues on the U.S. economy's health. Treasury International Capital (TIC) flows are also noteworthy. They have surprisingly defied predictions of a sell-off in U.S. Treasuries, which typically happens amid uncertainty. Turning to the euro, its fate seems more sensitive to the outcomes of the Trump-Putin meeting and the broader Ukrainian conflict than the dollar does. The early Monday trading of ERUS, USD, URCHF, and URJPY will serve as key indicators for how markets absorb any developments from Alaska. The Eurozone's long-term valuation has been pressured by a worsening terms of trade, largely linked to high energy costs. If markets start gaining confidence that energy prices could structurally decline, this could justify stronger euro valuations, even beyond levels that might currently seem unsupported by interest rate differentials, such as surpassing the 1.20 mark against the dollar. That said, as we've discussed, today's meeting could represent only a tentative step towards de-escalation, so market participants might remain cautious. The shift in expectations about Federal Reserve rate cuts has complicated prospects for a significant euro rally. Upcoming U.S. economic releases will be crucial in determining whether the euro can regain ground toward the 1.180 level in the near term. Looking at Central and Eastern Europe, CEE, the region has been relatively quiet lately, awaiting the results of the U.S.-Russia discussions today. The stronger-than-expected U.S. PPI and a firmer U.S. dollar have put some downward pressure on CEE currencies. But the overarching sentiment is to hold back until the meeting's outcome is clear. Interest in this summit is intense because a peace deal between Ukraine and Russia would bring significant stability to the region. It could lower energy prices, particularly vital for countries like Hungary, which depend heavily on Russian imports, and potentially spark economic growth driven by funds flowing into Ukraine's reconstruction efforts. The recent rally in CEE currencies since the summit was announced shows the market is already pricing in some degree of optimism. This complicates matters, especially for pairs like Euro HUF, which stands near 11-month lows. In contrast, the risks for Euro PLN and Euro CZK appear more balanced. Given the uncertainty, it's likely investors will reduce their exposure to the CEE market, particularly considering many have already established sizable positions. Profit-taking seems probable, reflecting a cautious stance until the talks conclude. Since the meeting's outcome is expected after CEE trading hours, the real market reaction will likely unfold on Monday morning. Shifting gears to Turkey, the Central Bank of Turkey, CBT, revealed several adjustments to its monetary policy framework during a recent press conference tied to its new inflation report. It maintained its inflation forecasts at 24% for the end of this year and 16% for 2026, numbers that are slightly below external predictions, which estimate 29.5% and 19.4% respectively. Notably, the CBT will now publish interim inflation targets in its reports, aligning these with its inflation forecasts. While this move could be misunderstood in the markets, it arguably offers clearer signals about the central bank's intentions going forward, especially as these targets might evolve. Looking ahead, the CBT sees upward inflation risks primarily coming from food and service sectors. Although further interest rate reductions are anticipated, the pace of cuts is uncertain. The 300 basis point cut implemented in July might not set the precedent for subsequent meetings. Encouragingly, recent inflation data has been favorable enough to allow for at least one more significant 300 basis point cut forecasted for September, followed by a slower pace of about 250 basis points. Overall, the bank expects inflation to close the year around 35%, though rate cuts could reduce the attractiveness of TRY carry trades, where investors borrow in low-yield currencies to invest in higher-yielding assets. The environment still supports such strategies for now. The central bank appears confident in managing its foreign exchange policy, with no imminent changes expected in this domain. Our view suggests that, through the summer months at least, USD TRY will trend gradually higher while continuing to offer rich carry returns. This makes the TRY a favored currency play.